welcome to PwC IFRS Talks, your source of all things IFRS, technical accounting matters, business issues, current standard setting and regulatory updates. I'm your host, Ruth Preedy. In today's episode, we're going to talk about IAS 36, Impairment of Non-Financial Assets. And I'm joined today by Dave Walters, whose official title is Lord Dave Walters of Hoogan Manor, I've just discovered. Welcome to the studio, Dave.
Well, thank you very much for that invitation. I must admit that the title was purchased for me as a recent birthday present from my sister, so the title might actually be impaired.
Starting with the joke straight away. Oh, no, don't be silly. I said to Dave, how would you like me to introduce you? IFRS technical partner. He was, no, Lord Dave Walters. So very excited to have a Lord in the studio today. This is very special. And you're talking to us about one of my favourite standards, Mr. Walters, IAS 36. Now, we have had a podcast before on impairment, but we focus very much on the cash flow model and where people can go wrong in the cash flows. But we didn't really get into how you move through the standard and the basics behind impairment and other areas people can get. So let's start at the beginning. What is an impairment?
So an impairment arises where essentially what you've got on your balance sheet isn't worth what you're carrying it out. So whether you use it or sell it, you can't recover the value that's on your balance sheet. And if you're in that situation, you have an impairment.
Okay. And how often do you have to do an impairment? Are there rules around that?
There are rules around impairment testing, and essentially they're driven off the nature of the assets that you're testing. So if you're testing goodwill for impairment, then you have to do a test every year. And really that's because goodwill isn't amortised. Other assets, if you were testing fixed assets, you only test those when you have a trigger for an impairment test, such as my factory has been destroyed, and that is a trigger that we've advised people on before.
Okay, yeah, an obvious one there. What other triggers might you have other than destruction? I suppose is an obvious one, but any more subtle ones?
More subtle. I mean, usually there's things like the disappearance of the market for the product that you're making. The market has gone, prices have declined, so new competitors entered the market. Interest rates have gone up, so the expected return on assets should have gone up. There's a variety of triggers that are kind of helpfully listed in the standard for you to consider, but really the underlying question is, has something happened that means that I'm not so convinced as I was that I'm going to recover this value?
Yeah, so even things like if the economic environment changes and things like that, that can have an impact on what cash flows you think you're going to get from the asset.
Yes.
And like Dave says then, the standard sort of breaks it down, doesn't it, between internal triggers, which might be your destruction example, or external triggers, things that are going on in the market.
Correct.
So once you've either tested goodwill, for example, or you've got a trigger, what is the actual test? What do you have to do?
So the test, first of all, says, well, let's identify what we're testing. So I need to work out what is the smallest group of assets that generates largely independent cash flows, called a cash generating unit. And that might be your factory. So it's the fixed assets in the factory, it's the building itself, it's the machinery that's in it. You might in fact be allocating goodwill to that. You need to identify what is your cash generating unit and the carrying amounts that relate to that. And you then need to compare that carrying amount with the recovery amount, which is the higher of value in use. So what's the value to you of continuing to use those assets, or what you could get for it in a sale, so fair value less cost to sell. And if either of those values, the value in use or fair value, is higher than your current carrying value, the news is good. You don't have an impairment.
Mm-hmm.
And maybe you don't need to calculate both of them. If one of them's higher, then you're done.
Yeah, okay. So really checking what's on the balance sheet in comparison to, like you said, what you can get for it. And again, just linking back to our other podcast, when you get into value in use and fair value, that's when you get into your cash flow models and what should be included.
Absolutely.
One of the other things you mentioned there is a cash generating unit.
Yeah.
My experience is that in itself can cause a whole raft of questions and problems.
It can.
What sort of things do you see where, people struggle with cash generating units?
Well, I think in many cases, people are tempted to look at a very high level to identify their cash generating units and say, well, all of my cash flows for my business are interdependent in some way, and therefore can I just test for impairment at a group level? When in fact, in many industries, the CGU is at a much lower level. So if you think about retail, for example, if you've got a network of stores across a country, stores that are in different towns, the cash flows arising on your store, from where I'm from in Birmingham, are likely to be largely independent from the cash flows from the store in London. The same customers will not be visiting both. So actually, in a retail sector, for example, you would typically start off with the assumption that my CGU is the store. And so if you have a trigger, so the economy in Birmingham turns down, whereas the economy in London stays fine, then you might have an impairment test in Birmingham, but not the same trigger in London.
Yeah.
So identifying CGUs is actually quite a tough task, and that's before we get into talking about things like goodwill.
Oh, which moving directly on. Just on your point there, I suppose if you don't identify the correct level, so back to your Birmingham, London store, if you just looked at that as like the whole of the UK, then you might have an impairment in Birmingham, which is effectively being shielded by the good cash flows in London. So that's why I suppose why the standard pushes you to the lowest level first.
Yeah.
So moving to your exact next point is how does goodwill fit into that?
That's an interesting challenge, because actually when the standard was being developed, I think the standard setters were aware that conceptually they would quite like to run with a model that says people would allocate their goodwill to all the CGUs within the business. If you've made a big acquisition, let's say a portfolio of retail stores, conceptually, if you're looking at your return on those assets, you might allocate the goodwill that you've got to each store on some basis. That's conceptually what you might do, but practically that's not what people do. That's not how people manage businesses.
Yeah.
So the standard setters said that what you must do is you must allocate goodwill down to your operating system. But they won't insist on you allocating it any further down, as long as you're not monitoring your return on net assets, including some allocated goodwill at a lower level. So they were trying to say, we won't make you put in new systems, but we do think you should allocate goodwill at the very least to segments, because effectively you're telling management that's how you're managing the business and assessing the return on the investments that you've made. So with that rule then comes a little bit of complexity, in that you may well have a two-stage test for impairment. So sticking with our retail example, we have a trigger for an impairment test in Birmingham, and what the standard would say is you look for your triggers at the lowest CG levels first, and if you've got any impairments, you take those impairments at that lower level. Then you aggregate your CGUs into that smallest group to which you can allocate the goodwill and have allocated the goodwill, and do your impairment test at that aggregated level. And at that stage, if you have any impairment, it gets allocated to the goodwill first.
Okay, wow. So you lowest level first, and then you do a second test on goodwill. And there you said as well, the standard obviously says no higher than operating segment. It could be lower than that if they...
and I have certainly seen examples where people have pushed goodwill a very long way down, but there are many companies out there who don't allocate it any further than they have to, because they don't use that data in their day-to-day business.
Okay, brilliant. So the levels thing, I think, is always a tricky area of the standard. The other thing I see, which would be good to get your perspective on, is the apples with apples. What's in your CGU and what's in your cash flows, those things. Do you see lots of issues and difficulty in that area?
The whole premise of the impairment testing regime is to try and compare apples with apples. So ensure that your cash flows are consistent with what you're testing. So actually, one of the practicalities of the impairment test is the standard says you should test your non-current assets. So I should test my goodwill and my fixed assets. People rarely prepare forecasts that look at those assets in isolation. They'll usually be preparing forecasts for the business. So it might be my retail stores in the southwest of England. Well, those retail stores have inventory, they have receivables, they have payables. So if your cash flows are forecast on the basis of, at that business level, the movements in working capital, then you should include the working capital in the assets that you're testing for impairment, to make sure you are comparing apples with apples at that basic level.
Yeah. Yeah, so I think, I know we're straying slightly into cash flows there, but it is really, okay, identify your CGU, look what it's in it, but then make sure you are comparing it to the same thing on the other side.
Absolutely.
Otherwise, you can either mask impairment or actually have an impairment that maybe doesn't even need to be there. So,
absolutely,
tricky area. Other thing just to touch on is, what do you do with corporate assets? So things like your head office, how does that fit into an impairment test?
It's unlikely that your corporate office will generate
by itself with your accountant sitting in there.
So it wouldn't be tested as a CGU by itself. The standard there gives us a couple of options. One is if you can allocate your corporate assets on a reasonable and consistent basis to your CGUs, then it suggests you simply allocate the head office on the assets. And we're talking about head office, you might well be talking about central IT systems, which is quite often a much bigger number, or indeed brands.
Yeah, brands, when I say that.
So you would allocate them on that reasonable and consistent basis. If, however, it is in the judgment of management, based on the evidence you've got, it's just too difficult to allocate on that reasonable and consistent basis, then you're into two-stage impairment testing again. So the standard would have you test your CGUs excluding the corporate assets from impairment, taking any impairments that are indicated, and then put it all together, put the corporate assets together with the CGUs they support all together, and test at that combined level. And if you have an impairment, then you would apply that to the corporate assets and indeed the underlying assets on a pro rata basis.
So just on that point, for that and goodwill, we talked a little bit about allocation. Are there any rules in the standard of how to allocate the impairment once you come up with it?
Oh yes.
Of course there are.
Oh yes. So if you've got goodwill in the CGU that you're testing, then that's the first thing to go.
Get rid of that first.
Get rid of that first. Thereafter, you allocate in principle on a pro rata basis to all of your non-current assets, whether they're tangible or intangible. But you're not allowed to write down any individual asset below the higher of three numbers. Now, one of those numbers is 0. So that's,
you can write it off. I can ignore that one.
You can't go negative. The other is if you can determine it, the value in use of the individual asset, which is unlikely to be able to determine, or alternatively, its fair value. And so what I see fairly frequently in practice is that when you hit that test, if you've got a lot of property and there's an observable market value for the property, you might not be able to allocate that impairment pro rata to that property because you can't write it down below its fair value.
Yeah.
So you end up having to allocate the remainder of the impairment charge to the other assets. So you might quite frequently see that property values stay roughly where they were, but intangibles get written off.
Yeah, okay. So there, after goodwill, there's no sort of real order of allocation, but you almost have this allocation and reallocation so that you don't take any assets down too low.
That's right. You're not allowed to take any assets down too low, so it becomes quite an iterative process.
Yeah.
And it's a time-consuming process, which I guess is again one of the reasons why, when it came to testing goodwill, which is standard set to say you should test every year, they didn't insist on you testing it at the year end. They gave you a bit of time to do it.
Yeah, big job for everyone every year. Yeah. Okay, so probably last thing as we come towards the end of the podcast is I'm always intrigued to know what's going on at the standard setter. So impairment, fairly old standard, but I think it's sneakily getting some airtime at the board.
Yes, it's a fairly old standard, and it's fair to say it's a fairly unpopular standard as well. It's not consistent with the equivalent under US GAAP, though they have their own slightly bizarre rules in places. But the concept in the impairment standard of working out what is the value in use for an asset has always been something that has created some difficulties in practice and amongst the valuations professionals talking about pre-tax cash flows discounted at a pre-tax rate. That's not how valuations practices work. Yeah. So the standard setters are having another look, and one of the options that's very firmly on the table there is to say, well, should we just move to a model that says should be fair value to determine what our recoverable amount is, and that I think is something that would have plenty of support in practice and move us certainly closer to where the US is. Yeah. And make valuations professionals happy, which dealing with valuations professionals, some of them can be quite miserable.
You just lost us a load of numbers there, thanks Dave. I don't have the same view.
I'm jesting, but actually to move the standard to something that the professionals themselves recognise as a valuation basis is clearly something that would be desirable. So yes, having spent many years on the stocks, they are having another good look at impairment.
I'm proposing to get rid of pre-tax discount rates, which
That's
is very exciting. I feel like I won't have anything to do in my life. I'll just have to record podcasts forever if that question goes.
I think impairment testing, even when you move to fair values, for the vast majority of assets we're testing, there's not an observable market value. So you're in the world of estimating what the fair value would be. And estimates and judgments is a happy hunting ground for accountants everywhere. So I think services will still be required. Yeah.
Oh, thank you. That's good. Well, thank you very much, Lord Dave, for joining us in the studio. Do you have any parting words before you leave us?
On impairment, I think one of the critical skills in impairment testing is to try and minimise the gap in years between the trigger event and the actual write-down. It's actually an area that is of continual high interest to regulators.
Yeah.
So I certainly see here in the UK that the FRC continue to focus on this as a key estimation area where they are looking for reasonable and supportable numbers to support the valuation. So it's an area that remains under intense focus and is a provider of a steady stream of queries.
Okay, thank you very much. Great parting word there. So we talked a little bit around IAS 36, the model. So when do you do an impairment test? What is an impairment? Maybe some of those tricky areas about levels of testing, so cash generating units, and then some great updates there on the board and what regulators are looking for. So thanks for joining us. That's the end of today's podcast. Happy accounting. The preceding programme was brought to you by PricewaterhouseCoopers LLP. This content is for general information purposes and is not a substitute for consultation with professional advisors.